You can instantly manipulate your credit score using this one factor. The credit utilization ratio accounts for 30% of the FICO model. This makes it the fastest way to see significant score changes. Utilization is calculated by dividing total outstanding balances by total available credit. Maintaining a utilization ratio above 30% signals high risk to lenders. This significantly lowers your overall credit score. The 30% ceiling is a critical threshold for all borrowers. The optimal utilization threshold is below 10% for maximum scoring benefit. Pay down revolving debt just before the statement closing date. This maximizes the reported available credit on your report. High utilization on a single card is penalized more heavily. Spreading low utilization across multiple cards is a better strategy. Payment history constitutes 35% of your credit score calculation. This makes it the single most heavily weighted factor. A single 30-day late payment is reported to the credit bureaus. This can cause a score drop of over 100 points on high scores. Bankruptcies remain on the credit report for 7 to 10 years. The exact duration depends on the specific chapter filed. Collections accounts and charge-offs also remain for 7 years. This 7-year clock starts from the date of the first delinquency. Consistent on-time payments are the only way to mitigate past negative history over time. Secured loans and unsecured credit are weighted equally in the payment history calculation. Maintaining a perfect payment record is essential for maximizing your score potential. The length of credit history accounts for 15% of the score calculation. This factor considers 3 specific metrics simultaneously. These metrics are the age of the oldest account and the age of the newest account. It also includes the average age of all your accounts. Closing old, unused credit cards negatively impacts the average age of accounts. It also reduces your total available credit limit. This reduction can potentially increase your utilization ratio immediately. Lenders prefer a history demonstrating responsible management over many years. The longer the average account age, the higher the score potential. This assumes your payment history remains clean and perfect. Accounts closed in good standing continue to be reported for up to 10 years. Do not close your oldest accounts unless absolutely necessary. New credit, specifically hard inquiries, accounts for 10% of the score. A hard inquiry occurs when you formally apply for new credit. This action temporarily lowers your score by 2 to 5 points. Multiple hard inquiries within a short period are often treated as a single inquiry. This short period typically ranges from 14 to 45 days, depending on the scoring model. This clustering rule applies specifically to rate shopping activities. Examples include applying for mortgages or for auto loans. This prevents excessive score damage during necessary shopping periods. Hard inquiries remain visible on the credit report for 2 full years. However, they only impact the actual score calculation for approximately 12 months. Limit applications only to credit you genuinely need right now. Credit mix accounts for the final 10% of your overall credit score. This factor assesses the variety of credit products you manage successfully. Credit types are categorized primarily into 2 groups. The first is revolving credit, such as standard credit cards. The second is installment loans, like mortgages or student loans. Demonstrating responsible management of both types signals lower risk to creditors. Having only one type of credit limits your potential score ceiling significantly. Installment loans have a fixed payment schedule and a defined term. Revolving credit allows variable payments and fluctuating balances. Opening too many accounts too quickly, regardless of the mix, negatively impacts the score. A balanced mix shows financial maturity to lenders. The Fair Credit Reporting Act grants consumers the right to accurate credit reporting. This federal law mandates specific dispute procedures for errors. If an error is identified, consumers must dispute the information immediately. Disputes must be filed directly with the credit bureau or the original creditor. Bureaus must investigate the dispute within 30 days of receiving the claim. If the reported information cannot be verified, the bureau must remove the item. This removal must happen promptly and without charge. Filing a police report for identity theft is a critical step. This allows consumers to place a security freeze on their file. A security freeze prevents unauthorized access for new account openings. Know your rights under the Fair Credit Reporting Act. A higher credit score directly translates to lower annual percentage rates on loans. This significantly reduces the total lifetime cost of borrowing capital. A borrower with a score above 760 qualifies for the lowest available mortgage rates. This high score potentially saves tens of thousands of dollars over the loan term. Compare this to a borrower with a 620 score who pays much more interest. Credit scores also influence insurance premiums in most states. Insurers use credit-based insurance scores to assess risk for policies. This applies to both auto and home insurance policies. Landlords and utility companies frequently use credit reports. They determine eligibility and security deposit requirements based on your score. A low score increases your housing costs and deposit requirements. Your score is a direct measure of your financial opportunity. Becoming an authorized user can provide an instant score boost. This works if the primary card has a long, perfect payment history. The card must also maintain very low utilization. This positive history is instantly imported onto your personal credit report. This strategy is highly effective for individuals with thin credit files. It also helps those actively rebuilding their credit history. The primary account holder remains legally responsible for the debt incurred. If the primary user mismanages the account, negative history transfers too. This negative transfer can potentially damage the authorized user score. Always confirm the issuer reports authorized user history to the bureaus. Not all card companies follow this specific reporting practice. Focus on maintaining utilization below 10% consistently. Ensure 100% on-time payments to maximize the 65% core scoring weight. Review all 3 credit reports annually for free. Use annualcreditreport.com as mandated by federal law. Implement a credit monitoring service to receive immediate alerts. These alerts notify you regarding new accounts or hard inquiries. This practice mitigates fraud risk immediately upon detection. Credit score improvement is a long-term process requiring consistency. It is driven by responsible, disciplined financial behavior. High scores unlock the lowest capital costs available. This maximizes your personal wealth growth potential over time.